Today, I sat down with Ashish from Investor Friendly CPA, where he shares a story of how he helped one of his clients save money on taxes through a 1031 exchange. Okay, so the first question I have for you is, what is the accountant's role in a 1031 exchange, and how do they collaborate with not only with us as the qualified intermediary?
And that's, I think, the most important question. Where we come in as a CPA is because what happened last few years when this real estate was changed, like an exchange was changed just for real estate, it was all over the news, right? And people thought they could just sell the house and then go talk to you and save money. That's not the case. So everyone should first speak with their accountants rather than QIs, right? They should speak with their CPAs, run the scenarios, saying, is this even worth it? Because I had a client who did already work with QI, came to us, who was actually losing money. He even didn't need it, 1030% exchange. He saw TikTok or all these podcasts and thought it was a great thing. It's not a great thing.
Right.
There's some people, depending on your tax bracket, your tax situations, and what you're buying, what your long-term goals are, everything needs to be analyzed. And your accountant and your CPAs are probably the best person to analyze those things. And then they will refer, and talk to you, hey, go talk to my friend who can do this for you, right?
Yeah, no, we see that all the time. They come and they're like, hey, does this make sense? And it's like, look, from our end, we could talk high level, right? Here's what overall it would look like, but to get the true number, your CPA has that. They have those numbers.
Yeah.
And so to really determine if it makes sense, because we see clients who they're happy deferring. If they can defer as minimal as possible, they'll still defer it because they don't want to give anything to the government with it. But others, they're like, it makes perfect sense for them.
Absolutely.
From that end. So all the time they're coming with us, and obviously we're not their CPA. We don't know their numbers of how things have gotten to. So we're always like, hey, talk to your CPA, make sure the numbers make sense, and it goes into your overall, because this is just one picture of your overall tax situation as a whole too. So that's stuff they have to take in consideration with that.
Yeah.
No, absolutely.
And don't you think, like what I've seen is you could save $10,000 in taxes, but they're going and buying this, they have this identification period and they're buying this property, they're going to lose $2,000 a month now.
Right.
What's the point of deferring $10,000 in taxes, deferring, not even avoiding, and then later going buying property which you're losing $2,000 a month, which actually you lose every single month. In 12 months, you're already $24,000 in the hole. So it doesn't make sense. So you have to really run the numbers. So that's what your CPA's role is. Run the numbers, understand your cost-benefit analysis, and then make a decision.
Makes sense here. So so overall, as an accountant, can you explain how the 1031 exchange help defer capital gains tax? From your perspective, how does that work? From an accountant's perspective, overall for their clients.
Perfect. This is I think this was obviously lobbied by rich people. That's what it is. And they wanted more real estate transactions, so every other industry would flourish. That was the whole purpose. You need to understand the purpose behind the tax laws. There's always something that's driving it, right? But the good thing about real estate, all of us are involved in real estate. We understand this is a heavily lobbied industry because of depreciation. It helps rich people with taxes, and 1031 exchange is exact same thing, right? The reason people save taxes with this is you can build generational wealth without actually paying taxes. And it's very simple. To make it extremely simple so every audience understands this, is you buy a property and it appreciates. It appreciates $1 million in appreciation. You just buy another property, move up, or buy the same property, similar property, or you want to change the market. You want to change one non-taxable estate, or again, your reasons after talking to your accountant, you just move up and buy another bigger or same property. You defer taxes. You don't pay anything, right? That's how it works. Details, there are a lot of other details we need to understand and follow, but once you buy the new property, you defer all those gain and also depreciation recapture, and then you die and you give it to your children or heir, whoever you want to give it, and then the deferral just vanishes. Now you avoid the two steps, right? You defer first, and then you give it to your generational wealth, wherever you want to put your money on properties, and then they don't pay any taxes when that happens. That's how all this, I'm saying this, and I've seen this in my own, practice. Wealthy people, this is the only one way they keep their wealth. Because the business, when they hand over their business to their kids, the kids don't care about running day-to-day business. The business vanishes within few years. Most of the, from what from the research we have seen, real estate is passive, even for the generational wealth. So this goes without tax-free, and everyone makes money. So the bottom line of how 1031 exchanges work is you defer your taxes first. Easy process. Talk to Ryan. He'll make it happen, right? Yeah. And then die, and you're wealthy. You're taking care of your kids.
Right. And you bring up a lot of points there, with that, and you start off saying, buy, you sell, and you want to buy something equal or greater in value, right? That's one of the main principles we talk about with the 1031. But the ability to change asset classes, but also geographically, right? Diversify geographically, and that's one of the points we always bring up with people, and to look into it, over their overall picture with that, do I want to go out of this commercial property into single-family rental homes because their return might be better, or it's less of a headache of maintenance-wise, but I still have that return there? Or geographically, do I want to get out of a high state income tax location and move and go to a Texas or a Florida or a state that doesn't have income tax, from that end, and generate through that? Plus the deferral aspect of it, you're now able to utilize more money towards the purchase. You're not having to, what I say, earmark and put that money to the side that you would have to pay taxes on later. You now have more net cash to actually use towards the purchase, and that's the beauty of the 1031 from that a lot of people then start to see the value of that on that. So, as a CPA, when clients come to you, or you hear, they're like, hey, what's this? And they're talking, I've heard this or that. So what are some kind of those common misconceptions you've seen clients have about 1031 exchanges? I see one for us that we always bring up, and everyone thinks it's an all or nothing situation, and that's not the case. You can do partial deferrals or trade down in value if it makes sense. Take some cash. It's better than nothing, right?
Absolutely.
So that's one of the misconceptions we always see, or that it's always, from our end, a like kind. Oh, if I'm selling a single-family home rental, I have to buy a single-family home rental. Again, not the case. So what about from an accountant's perspective, that you see on that end?
I'll tell you what's the biggest misconception is you sell and then you talk to people. That's one of the, again, especially a smaller group who cannot hire, professionals to begin with. You understand this, right? Real estate is extremely, it can make a change of finances, and they will have inherited this property, or they will have this property for a generation, and it's a huge sum of money if they sell it. They'll sell first, and then it hits them with taxes, and then like, okay, I got to talk to someone.
I didn't know.
Let's say I can do 1031 exchange, and they go online and look at, I can actually save taxes with 1031 exchange, and then they'll talk to me. One of the biggest misconceptions, especially with the smaller clients, or who's doing first-time transaction. So what you should avoid, and misconception the people have is, talk to a professional before. If you're going to save, $500,000, $600,000 on taxes, pay someone five grand. It's worth it, right? So that's the biggest misconception, and all those things you said, going to different asset classes, is very important. You might be done with 20 rented properties. Now you want to be passive, still don't want to pay $1 million tax, and then get to a multifamily. Buy multifamily. People don't understand that. State taxes, sometimes people forget about state tax implications. Also, misconception is, when analyzing, you have to make sure you factor in net investment income tax, right? Because that's another 4%, and it can be significant depending on your gain. 4% I've seen $100,000 of just net investment income tax that can make or break a deal. So many other things. Again, accountants, that way need accountants to run the numbers, so there's no misconception on the numbers first, and also understand the procedure. I had a client who actually, not even kidding, it was in, I think, North Carolina, bought air rights. You can do that,
right?
And you really seen that practice. I was lucky enough to see that. He sold extremely wealthy, crypto guy, and wanted to put money everywhere. And then he bought air rights, and I think he did very well from what I understand from that rights. But don't limit yourself. Talk to a professional.
Right.
That's the biggest misconception. Don't do it yourself. This is not a DIY project. People don't understand this.
Yeah, the lazy man's 1031, I guess. Yeah. So when we kind of see, from that too, one thing we always see too is, I thought I only had to reinvest my profit, and it's like, no, the big thing is, the IRS, the purpose that we see is they want the same amount of money in the market. So if you pull the profit, you're going to get taxed, from that end. So that's something else we kind of see come through that. And they're like, well, I thought it was just this. It's like, no, everything has to go in. So that's trading in equal greater value. If you want to trade down, take some cash out, that's fine. Just know that that's going to be taxable from that situation.
Yeah, and to talk about misconception, I guess this is another thing we need to be careful. And I should have brought this up. You're so right. People will come and say, okay, no, I don't want to do this. I'm so forced to do this because, I don't want to pay taxes. Just take some money home. Relax, and you earned it. Go buy Lamborghinis, Take $100,000 in your pocket.
Go on a nice vacation.
Exactly. Right? You can do so. And this is where the misconception we just said also goes to this another strategy, because we're going to talk about this later on. It's like this opportunity zones, right?
Right.
It's different. This one you have to reinvest everything if you don't want to pay any taxes. Opportunity zone, you sell something, you don't have to reinvest your basis. Only gain needs to be reinvested. This actually you can take a lot more home back, but again, it's not the same strategy.
Then you got you're worried about larger, different
exactly.
time frame.
Different kind of strategies. You have to combine these to have a best strategy if you want to take some money home. So you're right. So many misconceptions. Talk to an expert.
Right, and even off of that, you talk about the generational wealth. And we say, obviously, building that wealth, that estate planning aspect of it, where this comes in. And, we have a term in our industry, the swap till you drop, right?
Exactly.
And you mentioned that about, hey, do this 1031. You could do another 1031, and keep going and building that wealth so that when you do pass, it goes to your heirs, they get that stepped up basis, right? They can then sell or continue on their end all from the value of death, and now they have their own little picture to worry about. And it's all still part of that whole estate planning aspect that people kind of don't realize how this could come into play from that end there. So
the other biggest misconception we cannot miss, Ryan, is this: it has to be same taxpayer. How many people come to you and they already screwed up? They might have been talking to some less qualified professional, and they already did the 1035 exchange and comes to us and try to report that, and it's wrong. The taxpayer has to be same, meaning if your property was in partnership, the partnership needs to do 1035 exchange, right? If you and your spouse own it together, normally in non-community state, you want to keep the same ownership.
Right.
That's one of the biggest misconception. I guess the two biggest misconception, if you want to summarize this, is doing the transaction, and then coming to us, and then not realizing how to structure it. Right. Other things like 45-day requirement, everyone knows that, you can Google it. But some of the more complicated ones, you do need to work with professionals. Yeah. Do not change taxpayer at the last moment. And you can put the same taxpayer. This is a real court case. What happened is, someone bought a property, bought in a partnership, and after they bought it, they distribute the asset. IRS says no, this cannot happen. So you have to be careful. Depending on your situation, you got to talk to a professional and then understand is that allowed? Sometimes it is, sometimes it is not. So you have to be very careful.
Yeah, especially I think with partnerships, how maybe that partnership is. If you dissolve it, there could be certain
you can do drop
tax
and swap
considerations that might be from that end. Drop and swap. Are there other assets?
Exactly.
But even from a partnership, make sure it's not if you have that tenant in common, you're dropping out into that tenant in common, but it's still hopefully not looked at as a partnership, which the IRS can do. So you have the proper agreements and so forth in place to help really distinguish it between the two from that end there. Yeah, and all the time questions. If I sell this way, can I buy like this? And there's certain caveats to where it's admissible. Where you can do it. But we've got questions all the time. Well, what if I had my wife? Well. We look at, what's the value that you're going from and so forth like that. Where do you live? Is it community property or not community property?
So can we talk about one? This is an extremely important topic, and I think this is going to really people are going to like this one, is tenant in common you mentioned. That's one of another misconception. But you can just abuse. I have seen IRS come back and destroy the entire 1035 exchange because people try to abuse this. People need to understand what tenant in common is. I give you just very basic example, okay? If a building like this, we're sitting here, right? Multiple floors. When you see this sky rises, they might have 5 different companies. 5 different companies can own that building.
Right.
That's what tenant in common is. Tenant in common is you don't care about who other person is doing. You're filing your own tax return. You have your own bank account. You're paying your own property tax
for your percentage.
Yeah,
your
it's
portion.
Only you. You own those buildings and you manage that. That's what a tenant in common is supposed to be. Now, what has happened with all this social media is. I've seen people trying to sell this. Let's buy a single family house in tenant in common, and then later on we can do our own 1031 exchange. People try to do that, right? Can you follow tenant in common rules to make that single family house non-partnership? Extremely hard.
Right.
The reason is, you have to file a partnership return when you co-own the property, unless you strictly follow some of the rules that IRS wants for tenant in common, especially basis limitation. Because people who go buy a property and try to write off the property through cost segregation, for you to write off the cost segregation, man, you have to have a basis tracking, and it's already a partnership. So what I'm saying is, another misconception is you cannot just do 1031 exchange by owning a property in tenant in common. You haven't even respected a tenant in common. You have to first respect the tenant in common. It has to actually be a tenant in common, and then do a 1031 exchange. So that's another, I guess, big misconception. People don't even talk about it because people don't understand it. So it's something that people really need to think about.
Yeah. That's perfect with that. And we always say too, you got to be able to work with your legal side, your legal counsel on making sure those agreements are in place. You really want to show that it truly is a tenant in common, management of duties and so forth, which all come into play to show that from that. No, that's great stuff. Appreciate bringing that up, because a lot of people don't see that from that end. So a lot of people too also don't know, outside, yes, you're deferring capital gains tax, right? But people don't realize there's this other tax that also gets deferred, and you briefly mentioned it earlier, depreciation recapture. Talk a little bit about depreciation recapture and how that comes into play with the 1031 with it, because we see a lot of people too, that have fully depreciated properties. Then it's like, what? Is that the perfect time to do a 1031 or not? So,
exactly. This is where you actually really see the value from both owning the real estate and selling the real estate. And the landscape had changed, Ryan, and everyone needs to understand this. Before it was simple, you'd buy a property, you depreciate for how many years? 15 years, 27 years, fully depreciate. Now okay, I'm ready. I'm not getting any tax benefit from this. Let's buy another property, and maybe all the fund I'm going to put it there and restart a depreciation on the other assets and the higher value bought. Again, there's a little more detail to this,
right.
But recapture can be also deferred. The good news, the maximum tax rate of recapture is 25%, right? Right. Or if you're in a lower marginal tax rate, it's lower than that. It's the maximum is that much, but people don't understand. That's another misconception. You don't pay 25% tax. If you're selling something and your depreciation recap, you're already in 10% marginal tax rate. You only pay 10% on recapture. So, but let's say you can also avoid that though. If with the right 1031 exchange, you can avoid entire recapture plus your capital gain. Beauty, that's the beauty, right?
Right.
And then then your kids get it. When you die, there's no recapture at all. That's what the beauty of real estate. You just depreciate asset which actually appreciated and never pay taxes on other income with that depreciation. That's what the 1031 exchange work. But the landscape had changed here, and people don't understand this. This is the biggest misconception is you buy the property and then you do cost segregation. Now you have this asset, right? And it has this furniture, fixtures. You're writing off the sidings and floors and everything. Now, when you go to 1031 exchange, those depreciation that you just took on those personal property, not real estate, you cannot defer that. You have to pay taxes on those things. So when you do 1031 exchange, this is where your CPA comes again. You have to run the numbers and say, okay, how much of cost segregation do you have to recapture, and how much is going to get taxed at what cost, and so is it even worth it? Now, if people buy a property and do 1031 exchange, and then if your depreciation recapture on those personal assets you have already taken depreciation, which cannot be deferred, it might not even be worth it, right? So you got to work with QIs and CPAs to understand this. So good news, first of all, if you have never done cost segregation, the rule is even though you have a furniture you're selling with the real estate, you can you can defer the depreciation recapture on those furniture, meaning you never segregated it.
Right.
But once you segregate the assets and treat them as separate assets, non-real estate, you have to actually there's no depreciation.
So there's always that plus or that pro and con. Everyone's so caught up in what's in the moment of this is what everyone's doing, but does it truly make sense for me in the long term of wanting to get to that? Absolutely.
That's the bottom line of depreciation recapture. Yeah. It can be deferred, but be careful when you have already done the cost segregation. If you wait long enough, if you work with your accountant, it might be still worth it. The depreciation recapture can be managed. That's what I'm saying.
So absolutely on that. So some we talked about a little bit with that. So we always said, when we talked about a little bit of the misconception that, it's all or nothing, right? When someone trades down in value, obviously what we have is boot, right? If they're not reinvesting those proceeds, there's some boot left over. How's that taxed? Like talk a little bit, is it a percentage? How's that get taxed? Is it from that end?
The boot, 100% of boot is going to get taxable until your gain amount is reached. Like, if let's say you sell the property and your capital gain is, only $50,000, but you took $100,000 from the deal, then you're not going to pay, and not everything is taxable. $50,000 is a basis, it's not taxable. So boot gets taxed up to your gain amount. But most of the time in this kind of transaction, people take boot is always 100% taxable because it's always a huge gain anyway. And that's why people do 1031st exchange.
Right.
If it was a small gain and you're still taking money out, then no one would do 1031st exchange to begin with. So it's still taxed at a capital gain tax rate, depending on long-term, short-term. It's mostly long-term problem most of the time on this 1031st exchange. You have state tax rate, your capital gain tax rate, which is maximum is 20% capital gain. State tax rate can be in the 5, 6, 7, depending on the state you live. And net investment income tax is another 4%, depending on your tax bracket. If you make more than $250,000, then it starts creeping in. So it's taxed as capital gain. Depreciation, you don't pay any depreciation recapture, right? But when you take that capital gain out, that boot, there's a portion of that is going to be depreciation recapture. It could be taxed at 25%. So many moving factors there, right? But it's not a marginal tax rate, meaning ordinary 37%. It's still a lower tax rate. That's what I'm trying to say.
Yeah. No, I appreciate. You can kind of see how it just becomes more complex. There's so much more involved, and like we said, we always want to talk to the CPA because there's just so much more that can be involved with just selling that property, how it was reported, how it was held, everything that goes along with it. What have you been doing with that property? Is that just one portion of the property over your overall tax picture? And again, does that make sense, from that end? No, great stuff. Appreciate you, talking a little bit more about that. And I know we're going to have plenty of conversations, around that and clients and everything. I know we work together and talk to clients together, and that's something we always, discuss. Hey, let's get the CPA on the phone. We're more than happy to talk all together about it, how the process is going to play out. Let's game it. That's what we always say. Let's game the process. What's your goal? How's it going to play in? How can we fit that in with the requirements of the 1031? So, no, absolutely great stuff. We appreciate talking about that, Ashish. Absolutely.
Of course.
So, Ashish, can you kind of talk us through one specific example of how the 1031 exchange played out? What was the benefit? What was the end outcome with that? From his savings standpoint from that.
Okay, let me think. So the biggest impact I've seen this made is that same thing we discussed before, generational wealth. I had this guy who had inherited property maybe 10 years or 15 years ago from his dad, big commercial property. He already saved tax when he did that, right? Whenever you inherit property, you don't pay, there's no, all the appreciation goes away. If he had sold that property right away, he would be fine. But he held on to that property 15, 20 years, and then it was appreciated almost 15 million something. Now, if he had sold that property, then he has to pay taxes on that $15 million appreciation,
from what
right?
he inherited.
I think he was in I forgot which state, in Colorado somewhere. But if he had sold that property, he would be paying almost $3 to $4 million in taxes. I'm talking about just income tax. Sometimes there's county tax, transfer tax, so many other things, right? $4 million of wealth preserved for his family through 1031 exchange it shows you how powerful this can be. Now, that money he saved, remember the good news about this is, I think he probably was paid off. He wanted cash to retire or something, and he wanted to enjoy his life. Now he deserved that. He can do 1031 exchange, buy a new property, and then get a mortgage on that property because it's a commercial property. It sustains itself. You can tax-free money. Remember, that's the power of loans, right? You go to the bank, say, I need a mortgage on this property. You get 90%, 80% of the value of the property. You actually end up with more cash by taking a loan versus going and selling the property, paying all the commissions and $900,000 in commissions and taxes and all these fees. You would end up with less cash, and you would have no real estate that could even, again, appreciate for your kids.
Right.
So that's how the 1031 exchange helped this client save $4 million and was in a better tax cash flow position then actually he would have sold this to the other people.
Right.
That's a very extreme example, right? I mean, extremely good indication of what 1031 exchange could do for your family and build a wealth. But again, like you said, you have both of us have seen smaller clients.
Right.
Right. Small clients who come to us. I had this guy, family who sold a property in Georgia, wanted to save $50,000 or $60,000 in taxes. It's pretty significant, but not as $4 million. $60,000. I think he said he saved that and funded his kids' education to one of the Ivy Leagues somewhere, and he was pretty happy about it because he would have lost that money. He went to the back, same exact scenario, paid off property, 1035 exchange to a better one. The new property is even better, it provides you more cash flow. On top of that, he just got a loan, and then he retired, whatever he did, but he used some of the tax money he saved. He could just fund it somewhere. Financial planning, retirement planning, right? You can use the money to somewhere else. But what are the steps though, right? People always ask, okay, I see the impact of this. What the steps should I be taking? Pretty simple. First, decide on, if this is good for you. Talk to an accountant, and I'm sure they will, rope you in with a QI, and you can find your own QI. Talk to them together. That's your action item. Just bringing this conversation to your professional is all you need.
Right.
Right?
Yeah. Don't wait till the last minute or after you sell the property. Like, then you get the surprise bill, and you're like, whoa, I didn't know about this on that end. But perfect example showing how it can help even from the most extreme on the high end to your everyday person who might just have that vacation rental that they just supplement for some passive income that they have, and how they want to sell it from that side. So again, we talked about misconceptions at the time. It's only for the super wealthy rich or those on that end, which is never the case. It's that everyday person who just has that one little rental property that they generate through, and how the 1031 can just benefit them, from that on that side there. So great examples, from that, showing to see how that works for them and on that end there. So I do appreciate you coming and sharing those examples with us, and how it benefited both the client, from the Colorado side and the property he inherited, and then your everyday mom and pop person who just has, the one property there that they just, they were able to get and save for and want to keep that going for them. So appreciate it. Thank you, Ashish.
Perfect.
And that right there wraps up our conversation. If you have any further questions about a 1031 exchange, make sure you give us a call.